Hi, I'm Brad McMillan, Commonwealth's Chief Investment Officer. Welcome to the February market update. The big news this month was a stock market decline, the first we've had in some time. In fact, you can argue this is a healthy thing for reasons I'll get into, and the fact that we have not had one in some time makes it, in fact, overdue. Why did this happen? Well, there were a couple of reasons. First of all, and probably the biggest reason, we saw some weakness in emerging markets. The Federal Reserve announced a reduction in its bond stimulus program, the taper as it's called, and that led to higher costs for money in those markets. They had grown used to cheap money, they had grown to rely on cheap money, and when the cheap money gets taken away, there is an adjustment to be made. That said, the uncertainty is damaging to them, but because they are so much stronger, because they have floating exchange rates now by and large, because they have much stronger foreign exchange reserves, there appears to be no likelihood of a systemic crisis like we've seen before. So we do have uncertainty, we do have an adjustment, there will be some pain, but it's nothing for the U.S. to worry about. Nonetheless, rising uncertainty did hit U.S. markets. The S&P dropped over 3% last month, which is something we have not seen in some time. We had the uncertainty. We had earnings coming in a little bit less than expected, slower growth. We had some hiccups in the economic data reports. Now, we had very strong growth in the second half of last year, and it looks like that may slow down a little bit in the first half of this year. That's okay. In fact, that's expected. But it's something that investors now need to incorporate into their market expectations, and the price adjustments are reflecting that. The other thing about the price adjustments is, given where we are from a valuation perspective, it's actually probably a healthy thing. Valuations are at relatively high levels on a historical basis, and it's important for values and prices to calibrate to get back to something close to reality on a regular basis. We have not done that in some time. So for it to happen now is not a bad thing, in fact, quite the contrary. Finally, if you look at the way the economy is growing, we're seeing slow but sustainable growth. A little bit of a slowdown is not a bad thing, again, so we don't get too disconnected from the fundamentals. What we have here is we have an economy that is based on sustainable income growth, sustainable spending growth, sustainable business growth. We're seeing the government come back in as a positive factor. We've seen the absence of a lot of the things that hit us last year. We don't have a tax increase this year. Overall, the signs are for the economy to continue to grow. And what that means is that should act as a cushion for any adjustments in the stock market. What we're also seeing is we're seeing interest rates tick back down, which should also cushion the blow for both the economy and the stock market. So as we move into 2014, we see continued moderate growth, sustainable growth in the economy, and we see a market that's in the process of adjusting. Right now, there doesn't seem to be a lot to worry about, although, of course, we'll keep an eye on it. Thank you very much, and I'll talk to you next month.